Now, we're in the thick of earnings season, and you've seen Macrotech Developers, the owner of the brand name Lodha, share price up by about 5 rupees right now, but you're seeing markets discount earnings too, even when they're good ones. And in this case, the bottom line has gone up 124% year on year. And more importantly, Macrotech has seen the best pre-sales in as many as 12 quarters. Here's Abhishek Lodha in conversation with my colleague Aisha.
The housing market is at the start, in our opinion, of a very significant change. And that is what is reflecting in the numbers, both for this quarter as well as I would say for even the previous 2 quarters. The demand is very solid. People especially are very keen to upgrade their homes to buying, better homes, bigger homes, various factors, including the cost of mortgage, the impact of COVID, therefore driving the need for some extra space. And in general, the fact that Indians have been underbought on housing over the last few years. In addition, salary growths have been quite strong. And as salary growth sort of, is increasing affordability, people are finding that buying homes is the right thing to be doing. We're also seeing the start of price rises now. And as people start seeing prices move up, they're moving up modestly, maybe 5% a year. But as they move up, people are more keen to make their decision in a timely manner. So all of those factors are leading to a groundswell of interest, much more footfalls, and better conversion levels.
As I see it, for the third quarter, you've seen strong pre-sales momentum. Abhishek, can it continue for the next few quarters too?
Aisha, we believe, and what we're seeing on the ground even now in January, that the momentum will continue to not only remain strong, but potentially even build up further. Now, of course, overall, the state of the housing market is quite linked to the state of the economy and the confidence in the job market. We see that those factors are likely to remain positive in India for some more time, for quite some more time. And therefore, the housing market, we believe, will continue to strengthen going forward.
Are you on track then for your pre-sales guidance despite the third wave, which is currently on?
Yes, Aisha, we are on track for our pre-sale guidance for the current fiscal of about 9,000 crores of sales. There has been a modest impact of the third wave caused by Omicron, but Mumbai has led in some sense the way we were, the first. Mumbai was the first to get hit, and Mumbai has been the first to start normalizing. The impact on sales has been quite modest so far, about 200 crores in January, and we figure that we'll be able to make that up and therefore continue to maintain our guidance.
Sure. One has clearly seen a project addition as well as capex surge post your mega QIP. Help me understand what's really happening firstly with the UK project. How much of it is still unsold, and by when is it that you're expecting to get it fully booked?
Sasha, we in the UK had 2 investments. The first project, Lincoln Square, is at the very fag end of its sales cycle and should be completely sold out in either 1 or 2 quarters. So we are pretty much at the end of that one. And the second project, Grosvenor Square, had a very, very strong rebound after the UK reopened travel starting from September. Between September to December, that project has sold about 290 million pounds, just under 3,000 crores in Indian rupee terms. And as a consequence of that, we'll be prepaying our bond. There is a bond we had raised for investment in that Grosvenor Square project, which will be prepaid almost a year ahead of maturity in the next 3 to 4 months from the sales proceeds from Grosvenor Square. And that's a significant repayment of about $225 million. Subsequent to that, in the next 5 to 6 quarters, but starting in fiscal 23 itself, almost all our investment in the UK will come back. So all our investment in the UK will be back to India in the next 5 to 6 quarters, which is ahead of our original estimate, which was by the end of fiscal 24.
And how many new JDAs do you hope to sign in the coming few quarters?
So we had estimated that with the QIP, we will accelerate our pace of growth into serving the markets where we believe there is a gap in terms of supply demand and where our presence is limited or not there. We have showcased that we are able to execute pretty quickly on the ground with our capital light model of growth, wherein we partner with landowners rather than buying the land, and we focus on the development. In the last quarter itself, we added 6 new JDA projects with a GDV value, a sales potential value of about 10,000 crores. And we expect that we will, over the next 4 to 5 quarters, further keep adding projects such that we'll total up to almost 40,000 crores of new projects over the next 5 to 6 quarters, including the quarter which is just gone. So we see very good interest in partnering with Lodha, given the strength of our brand, the sales that we can bring to the table, as well as the rapid execution that we do. And we see that this capital light model is the right mode of growth because it allows us to serve the markets we are not present in, but at the same time keep solidifying our balance sheet and allows the business to grow in a manner which is low risk.
You know, Abhishek, in my conversations after your earnings with a lot of analysts who track your company very closely, and the observation really has been that it's a deleveraging growth combo that Macrotech Developers is currently poised at. Now that your cost and debt has come down significantly, I wanted to understand whether or not your financing costs will further, get down lower in the coming few quarters.
Aisha, absolutely. I think you have very strong links within the analyst ecosystem, and you've picked up the right kind of thought process. It is a deleveraging cum growth story, which is not easy to pull off, but we find that we are able to deliver on both fronts. Our cost of debt has moderated by about 120 basis points, 1.2% over the last 9 months, and we expect this to significantly further fall going forward. We are targeting that by sometime in fiscal 24, our average cost of borrowings will be somewhere in the 8s. And that's a reduction of about 250 basis points from where we are today. So not only are we going to reduce our cost of leverage, which we certainly think we will, but furthermore, we will continue to de-lever our balance sheet. We are not at a stage where we are feeling that this is the right level of debt at all. Every quarter, you will see a continued reduction in our debt numbers because of the strong operational cash flows that the business is generating.
Abhishek, the other thing which is currently at play at a macro environment level for your industry is, although volatile, but labor costs, steel, cement, all have seen a very big inflation impact, especially in the last 3 quarters. Add to that, there is also that big overhang that perhaps the interest rate trajectory may actually turn. Could this be a big overhang for sales which are just about coming back for the realty industry?
I think one of the things, Aisha, we need to appreciate is that inflation is a reality. Inflation has to be dealt with in a manner where value engineering as well as the scale of buying helps you moderate the cost that go in, but inflation is a reality. We find that the construction cost intensity, i.e. the cost of construction as a proportion of sales price in India and especially in Mumbai is modest, somewhere between 30 to 40%. And therefore, even if there is a reasonable amount of inflation, it does not have a very significant amount of impact on margins. So far, we've seen that costs have gone up by about 3 to 4% as a percentage of margin. We find that with price growth back now, you can definitely pass that cost on to the consumer because wage growth is even higher and potentially even have a slightly higher price growth, which will help add to margins. So we do believe that inflation is real. We do believe that there are modes of and ways of trying to moderate its impact. But overall, we believe that the scenario is such that supply is moderate now. It's constrained, it's consolidated. And in view thereof, there is going to be ongoing price growth in this sector, which is great for the consumer because ultimately 70% of the wealth of Indian middle class is held in housing. And if every year home prices grow up by 5-6%, then you suddenly start seeing the impact of that from a wealth perspective in the middle class, and that spurs consumption. So we're quite comfortable with where inflation is and where price growth is.
Okay. Going forward, Abhishek, how is it that you're going to be deploying the surplus funds from the remainder of the QIP money?
Aisha, the focus of the QIP was capital for growth. And that is where we are going to continue to deploy that capital in the capital light model of joint development. We are focused on growing in a manner, like, as I mentioned earlier, into the markets where there is not enough high quality supply and where our presence is limited. And we find those opportunities to be, quite available on the ground. There's a large number of developers who are not so keen to continue developing. They have significant amount of projects that are ready to go, and that's where a developer like us steps in, helps bring the project to life, and at the same time helps the existing developer and their lender eventually find an exit through the cash flows of the project.
Could you spell out which are the new markets that you're looking at?
Markets-wise, geography-wise, we're still, fairly focused. We believe that real estate requires a lot of focus in every city that you operate in. And also, as long as there is growth opportunities within the geographies you're operating in, there is no point in adding to risk by, going into many, many geographies. So our focus markets are Mumbai and Pune. And as we mentioned at the time of our QIP, we continue to evaluate Bangalore. We're quite excited with the facts that we are seeing on the ground and the gaps and opportunities that we see a brand like us being able to serve. These are still early days, and probably sometime in the next three to 6 months, we'll come to our conclusion on whether Bangalore is the right place for us. But as things stand right now, we are focused on Mumbai and Pune and continue to be quite positive about what we are seeing in terms of opportunities in Bangalore.